Hi, welcome everybody. Welcome to our next in the ever-expanding series of the Markets Masterclass. For any of you who have missed some of our previous sessions, they are all available online. So after this, I'll share the link on LinkedIn for anybody interested in recapping on some of the previous editions that we have done. So today I'm joined by Colin McKee. Colin is head of financial risk advisory here at Lloyd's, and we are going to be exploring the topic of determining the right currency mix of debt and going through a couple of interesting points about that. We're going to be looking at hedging balance sheet exposure and earnings translation and some of the challenges that corporate treasuries face. And it tends to be a typically difficult issue for some corporate treasuries in terms of how they operate and what the typical factors are that are the main factors that drive the company's currency mix of debt. So we'll be looking at some of those challenges and looking at how companies adjust the mix of debt through the use of financial derivatives and or debt, and how those kind of play off and how they kind of play together. And we'll look at a few client examples. So, where clients are using balance sheet hedging or translation hedging or net investment hedging in terms of managing some of those risks and complexities around some of those situations. We'll also look at some common instruments that are employed by companies and that are used to hedge balance sheet or FX risk that arises from currency mix of debt. And afterwards, we'll be taking a number of questions. So please, if anything occurs to you during the presentation, please just pop it into the chat, and we'll take those at the end of the session. So welcome, Colin, and thanks for joining me again on one of these our next experience. So over to you.
Okay, thank you very much, Alex, and thank you for the introduction. I think, as you rightly pointed out, this can be a challenging area, and one in which there's probably potential for misunderstanding. And I think some of that comes from the terminology. So you touched on it in the introduction. People talk about balance sheet hedging, they talk about translation hedging, they talk about net investment hedging, and all of these different terms can sometimes be used sort of interchangeably almost. So we thought it would make sense to start with terminology and sort of try and explain at least what we think each of these things means, and then look at how they how that ties in with the optimal currency of debt. So to try and explain this, on the screen on page 2, you can hopefully see an illustrative group structure on the right of the page. So this is, I guess, as simple a group as we might get. We have a sterling reporting group headed by a UK functional currency, sterling functional currency company based in the UK, and it has one subsidiary which is based in the Eurozone, Euro functional currency. So maybe if we just walk through this structure very quickly, and I can then link that into some of the terms that I talked about earlier. So looking at the UK company, we have obviously assets and liabilities in the balance sheet. There are very likely to be some intragroup balances, and then there's the equity of that company. In the boxes around the side of the company balance sheet, you then have the usual cash flows that you would see of sterling income, currency income, interest costs, etc., dividends perhaps that are being paid to external shareholders. And then moving down to the European subsidiary, exactly the same. We have the balance sheet, assets, liabilities, equity, etc., and cash flows either in euro or foreign currency cash flows for that entity. So what FX exposures are there in this group, and how do we categorize them is probably a sensible place to start. Firstly, we have FX transaction exposures, which isn't really the subject of today's call. So I've sort of skirted over it in the bullet points on the left, but FX transaction exposures are cash flows generally in a currency other than the functional currency of the entity. So it could be euro cash flows for the sterling parent, or it could be, I don't know, US dollar cash flows for the European sub. And those generally fit into FX transaction hedging programs. So as I say, sort of not the topic of today's call. Then we get on to earnings translation exposures. So what do people mean when they talk about earnings translation? Well, the European sub in this example will be generating a net profit based on its inflows and outflows, if you want to think of it in those terms, in the P&L. It will report that profit in euros, but for group reporting, that will translate to sterling based on some kind of proxy for the average rate of the year, and therefore the sterling group, when it reports, will be subject to that translation risk. So the euro earnings will be worth more or less depending on where euro sterling moves. So that's earnings translation. Balance sheet translation can often mean a number of things, but in this context, I would probably use it to mean the translation of monetary items in the balance sheet. So you might have financial assets like trade receivables, financial liabilities, so debt in a foreign currency is probably the most relevant one for today, or foreign currency payables, etc. So all of those items will translate through the income statement relative to the functional currency of the entity, and again will give rise to FX gains or losses in the income statement. So when we talk about balance sheet hedging, often companies are talking about hedging those items that translate through the translate on the balance sheet, and the impact of which shows up in the income statement. Intra-group balances then are to all extents and purposes exactly the same as some of the sort of balance sheet translation exposures, because assuming these are monetary assets or liabilities, so for example, an intragroup loan from the sterling parent down to the euro sub in euros, that would also translate with gains or losses going through the income statement, albeit the balance sheet side of it will net to nil. And then finally, the net assets of the foreign subsidiaries and foreign operations, well, really that is just, if you look at the assets, liabilities, and hence the equity of the European subsidiary here, all of those items will be represented in the group balance sheet, assets and liabilities will, and they'll translate based on the closing rate. And those translation gains or losses will go through equity as part of the sort of translation reserve of the group when it reports. So you can sort of see we have a mismatch between that translation of net assets of foreign subsidiaries and maybe foreign currency debt that's considered to be a monetary liability of the sterling parent. And then that's where we get into some of these sort of hedging or hedge accounting concepts, let's say. So if I take balance sheet hedging, I think I've probably talked about that. That tends to mean hedging of items which will translate on the balance sheet, so monetary items, and which translate through the income statement. So that often means, in my experience at least, translation of those assets or liabilities or intra-group balances, where companies might, for example, have rolling FX hedging programs to sort of negate the impact of those FX gains and losses in P&L. Translation hedging to me is fairly interchangeable. It's probably the same thing, but again, people may use it to also mean hedging the translation of net assets of foreign subsidiaries. They may also be referring to earnings translation, but normally that tends to be referred to as such. And then net investment hedging, well, it's I suppose the same as sort of hedging the net assets of foreign subsidiaries, if you like. This is really how the accounting rules think about removing volatility. So if you have foreign currency debt, so euro debt in this example in the top co, in order to remove the FX volatility in the income statement of that debt translating, it can generally be designated as a hedge of the net assets of the European subsidiary. So that's really how the accounting rules think about it. So people then talk about net investment hedging as sort of hedging of those net assets. And then that brings us on to the final bullet in this page about, well, how much foreign currency debt can I have? There is a constraint driven by net investment hedge accounting rules that broadly companies probably won't have more foreign currency debt than they have foreign currency assets, because if they're using net investment hedging to sort of mitigate the P&L gains and losses, then that is sort of the natural cap. That's the amount of debt they can designate as a hedge of those net assets. So that was a bit of theory, I guess, to start with, and just covering.
Really helpful, I think. So really, what we're talking about is how do companies manage some of those translation exposures coming from those three bottom pieces of risk, really, and how do they kind of move forward. So I guess moving on, just the next slide is really just on the common approaches to the currency of debt question. So, typically what factors influence the group's debt currency mix, and how do they play out?
Yeah, thanks, Alex. So on this page, we've tried to cover exactly that. We've listed out some of the factors that tend to drive that currency mix of debt question, and this isn't by any means exhaustive, but it's certainly some of the main ones that we come across in practice and talking to companies and large and small. So just running through them quickly. So cash flow matching, first of all, what's the sort of rationale of this? Well, maybe it's fairly self-explanatory when you think about it. It's sort of saying that as a group that is active internationally, I will generate cash flows in a number of different currencies. So therefore, in order to enable me to naturally service my debt, a sensible approach might be to sort of split my debt in line with the currency mix of those cash flows, so that I can use my euro income or my euro dividends coming up from my euro subsidiary, for example, to service euro debt without having to go and purchase foreign currencies each time I need to make an interest payment. So that's the first one. The second one, there's two parts to this. So this is focusing on either the income statement or cost of funds, whichever way you want to look at it. So first of all, I've listed it sort of as the primary driver, if you like, looking to minimize the cost of funds and therefore maximize the bottom line, fairly obviously. And companies that look at this may very probably look to allocate debt in the cheapest currency or maximize sort of the share of debt in the cheapest currency, if you like. So at the minute, that might be euros for some sterling companies, given the sort of relative interest rates in the two currencies. And again, there tends to be a cap on the amount of foreign currency debt you would want. So you would probably look to minimize interest costs to the extent that, having more foreign currency debt doesn't sort of introduce excessive FX risk to some of the other metrics that you might want to look at. And then secondly, to the extent that companies have foreign currency interest payments, we talked a little bit in the previous page about earnings translation risk. Well, those foreign currency interest payments will create a natural offset in the group's income statement against the foreign currency earnings. So this also gives a sort of netting effect such that the group's overall P&L exposure to that foreign currency is less because it's offset by the foreign interest costs. And looking back over the previous few years when interest rates were low, certainly lower than today, this effect maybe wasn't that notable because interest costs as a proportion of the overseas earnings might have been relatively small. Given what's happened in the rates market and funding costs generally, this sort of effect is coming back a bit more. So companies will very probably pay attention to it. Next one on the page then is looking at sort of credit metrics, so credit rating ratios or covenant ratios. And most typically we might see something like leverage, so either gross debt or net debt to EBITDA, or the sort of public credit rating equivalents of that measure, or things like interest cover, for example. And the rule of thumb here is that if you want to reduce FX risk to some of these metrics in order to insulate them from FX movements, then you would look to align the proportion of debt in each currency with the proportion of debt in EBITDA. So you sort of look to align the splits, the currency mix in net debt with the currency mix of EBITDA. And in doing that, then you should insulate that credit metric from movements in FX rates. And obviously things change over time. EBITDA will move, the degree of leverage will move. So that's something that probably has to be rebalanced over time. But yeah, that's definitely an approach that we very typically see. And then finally on the page, I've said hedging net assets. Companies often talk about this if you look at risk management disclosures in their financial statements, and they talk about hedging net assets. They maybe talk less about the purpose of hedging net assets. And in my view, at least, this is possibly driven by the accounting rules and what I said a few minutes ago about the way that hedge accounting thinks about foreign currency debt. It sort of treats it as a hedge of net assets rather than some of these other concepts about matching cash flows or reducing income statement interest costs or hedging FX risk to credit metrics. Why might companies want to hedge net asset value? Well, I guess it's sort of it's an accounting version of maybe the economic value of the group. So to the extent companies want to sort of protect that economic value from FX movements, that can be done through having foreign currency debt in place. And companies can either look to do that in a proportionate manner. So if you have 20% of your assets in dollars, for example, net assets, you may look to put the same proportion of dollar debt in place. Or there might be circumstances in which, the company wants to maximize that offset. So it could be things like they may be divesting of a subsidiary or a certain part of the group, so they might want to sort of insulate as much of the FX movements as possible.
Can I just dive in there with a bit of some personal experience there? Just coming back to that hedging covenant ratios, particularly net debt to earnings or net debt to EBITDA, as you said there. I've seen in the past, it's not necessarily just about protecting covenant ratios that you have in your RCF or with your banking group, but sometimes it can be also a marker for your investor base in terms of how investors think about the value within the company. So, I remember the last time when sterling went up to, or cable went up to 2, which was admittedly a long time ago. But I had a construction material company that we were talking to at the time that had a sizable mismatch. They had very little debt, but they had a huge sizable dollar revenue stream. Probably 70 to 80% of their net revenues were coming in through US dollars. And when we saw sterling against the dollar go from 170 up till 2, we were having discussions with the FD at the time saying, this is going to weaken your revenue to bottom line. There might be an opportunity to put some hedging in place here. And at the time, the FD's view was that the market, buys the shares or buys us because of the dollar diversification play. And that was true at the time. But what we saw as sterling went higher and started to erode their revenue base, the shareholder base sort of turned a little bit and ended up selling them aggressively because of their drop in revenues into their functional currency, which was sterling at the time. So I think, I think all of these approaches need to be viewed constantly, as you rightly point out, and on a continuous timeline, because things do change. And you do see, particularly where you get some big trending moves, I think it's kind of important.
Yeah, I think that's a really good point, Alex, and probably ties into what I was going to say, that I think it's important not just to focus on one of these factors. So, we've certainly seen instances of companies getting it wrong, perhaps in the past. I mean, that was maybe one example, with different sort of shareholder behaviors.
Yeah.
But yeah, if for example, if you were to focus on cost of funds, you might sort of put all of your debt into the cheapest currency. But in doing so, you run a sort of the risk of having an imbalance to some of your credit rating ratios that could come to bite you down the line. Yeah, totally agree. So on the next page, we've tried to bring this to life a little bit by looking at some of the public disclosures of a UK listed company. So this is a large UK-based multinational, geographically active in most of the main regions of the world, as you can see from the sort of splits in the chart on the left. So I thought it might be useful to sort of just run through these quickly and try and tie them back to some of those concepts that we talked about on the previous page. So looking at the pie charts on the left, what can we see? Top left, we have gross debt. And, this is obviously a large company. It's got in excess of 40 billion of gross debt. Obviously won't be the case for everybody, but the concepts, very much hold as you move down the sort of size spectrum of companies. So this company has a significant amount of dollar debt, 71%. Followed by euros, some sterling, and then a tiny bit of other. So if we look at how that ties up to one of the measures of P&L, operating profit in this case, we can maybe take that as a proxy for EBITDA or a proxy of the cash flow split. It looks in the whole that it ties pretty well, I would say. So they've maybe got more dollar debt than they have dollar operating profit. But maybe the reason for that is that they're generating profits in other regions. So they've got Americas and Africa, they've got Asia Pacific, and perhaps some of that dollar debt is more correlated to those currencies than euros or sterling, for example. The euro debt matches quite well, very well, in fact, as you can see. And then they have sterling debt, but they don't seem to have any sterling operating profit. The reason for that is probably that they're UK headquartered, so have a lot of sterling costs, which is eating up all of the revenue, if you like. But you often see this, that companies will tend to maintain debt in their home currency. But on the whole, they look to be pretty well aligned, I would say. running through some of the comments then on the right-hand side. So what have they said about their currency risk management policy and approach? First of all, they've talked about what exposures they have, so US dollar, euro, Canadian dollar, Australian dollar, etc., but lots and lots of currency exposures. On the third bullet, they've said well, the policy is to broadly match the currency of borrowings with the currency of cash flows of the group's underlying operations. So that is sort of item number one, if you like, from the previous page, which I've summarized in the bottom left. So cash flow matching, they very much use that as an approach to drive their currency mix. Moving down to the next bullet, the group aims to minimize all balance sheet translation exposure where it's practical and cost effective to do so. And how does it do that? Well, it matches the currency of its assets with the currency of borrowings, or rather the other way around. So again, you could say they're hedging net assets by doing that, or at least they've sort of presented it in that light. They've talked about, using this approach if it's cost effective to do so, and if it's practicable, can they readily get debt in those relevant currencies? So that sort of touches on the cost of funds point and the P&L point that we mentioned on the previous page. Mm-hmm. And I picked this as an example because this company actually states the sort of purpose of doing that. Why are they taking this approach? Well, they've said the objective, or the main objective at least, is to protect shareholder value by increasing certainty and minimizing volatility in earnings. So again, they're sort of touching on net assets, as a proxy maybe for shareholder value. So I thought this was quite a good linkage between the theory of the previous page and then, a direct set of exposures from a large listed corporation.
Yeah, absolutely. And I think there's a couple of points that spring to mind for me there, having done pieces of work for large multinationals like this, where they were saying really what we want to do. I remember one client was looking at we were coming to a period of uncertainty for some of the emerging market currencies that were on their book, and they wanted to protect some of those revenues. And after looking at it, a lot of those were really difficult to get, debt into those currencies in, or indeed some of them were unhedgeable due to, them being NDFs or just being prohibitively expensive. And after doing the work, we realized that the most important thing was their exposure from sterling to the dollar, because that is the main. That is such a big piece of that risk compared to everything else, that it was more about the dollar debt and balancing that effectively and managing that piece of the book rather than all of the other individual dollarized emerging market currencies. So I think that's quite an important point. But
yeah, definitely agree with that, and I'd probably say the same for this company. By the looks of it, it's taken a similar approach, and they've also stated they don't sort of hedge translation of foreign profits, which a lot of which would cover some of those emerging markets as well.
Yeah.
So moving on to the next page, if the previous page was an example of a company that looks very well balanced and it's obviously large, sophisticated, we've actually done a lot of work with that company in the past and helped them to review their currency mix of debt, their fixed floating mix, which is something they do on a regular basis. So it's definitely something they monitor closely and in a dynamic fashion. The next little case study is an example of a company that maybe has taken a different approach for different reasons. So this is a European headquartered company that had fairly recently made a significant UK acquisition. So it's gone from having wholly sort of a euro balance sheet and largely euro cash flows to then having a large proportion of its net assets in sterling and a large proportion of its earnings in sterling. So if we look at the similar pie charts, again, it's first point is the size. I guess the gross debt is sort of give or take 500 million euros in this case, so much smaller than the previous example, and that debt is very heavily skewed towards euros at 95%. The company has a lot of cash, but a significant portion of that cash, the majority in fact, is sitting in sterling for various reasons about expanding the sterling balance sheet and trying to grow the sterling business. So that puts it in a rather unusual, but not something that we haven't seen before, net debt position of having more than 100% of its net debt denominated in euros and sort of negative net debt or positive net cash sitting in sterling. So if we look then at the bottom row of those pie charts, well, how does that match up with non-current assets? And again, this is all from public disclosures. And how does it sort of tie up with EBITDA? You can see a pretty stark mismatch, if you like, between net debt, which is, as I said, more than 100% euro based, and EBITDA, in which you have 54% sterling EBITDA, and indeed non-current assets even more than that, because the recent acquisition will very probably include a decent chunk of goodwill as well. So this isn't particularly unusual to see an imbalance of this nature. The reasons for it are, as I say, the company had made an acquisition, so it's coming from a position in which it had wholly euro funding.
Yep.
And also the relative cost of euro versus sterling debt at the time was such that they wanted to maintain a significant portion of debt in euros to get to sort of get that cost of funds pick up. So we worked with them. They were looking to refinance some of their debt that was coming up for maturity. It was roughly 150 sterling equivalent, and the question was, well, should that debt be in euros or should it be in sterling? And I mean, this is a relatively simple analysis on the right-hand side, where you can see FX risk to leverage. So they had a covenant at the time, which was net debt to EBITDA. And what do we see if you look at the dark green line? That shows the existing currency mix of net debt, and it shows what happens if we stress the euro-sterling FX rate. So moving to the right, we can see euro appreciating against sterling. And what does that mean? Well, it means that the sterling EBITDA that the company is earning is now worth less in euro terms. So you see leverage going up.
Yep.
Sorry, the light green line, I beg your pardon, for the existing debt portfolio. And moving to the left, you see the opposite effect as euro weakens against sterling. So the light green line is quite steep. So there's a decent amount of FX risk there as leverage moves around. If they were to rebalance by putting 150 sterling equivalent of that debt in sterling, that takes us to the dark green line. So you see much shallower, much less of a range of possible leverage outcomes given a reasonable movement in that FX pair. So just on the next page, that's all well and good in a sort of non-stressed scenario, if you like, when leverage was 2 times. This discussion was happening sort of at the onset of COVID. So we also made the point that, what happens when you stress some of these measures? Well, again, a simple example on this page, if you look at increasing gross debt, so an arbitrary figure, 25% here, so that the debt position moves, sorry, that's net debt, I beg your pardon, the net debt moves up to just over 300 million. And also you stress EBITDA such that it reduces, in this case by 15%. Well, what happens? Leverage goes up from 2 times to 3 times.
Yep.
And all of a sudden that FX risk becomes much more important. So you'll see the light purple line is reflecting that sort of stressed scenario with the existing currency mix of net debt. And 2 things, it's obviously steeper than it was before, so there's more FX risk at higher leverage levels. And also the company is very much in danger of breaching a covenant level. Whereas if they rebalance the dark purple line, then that gives them at least a bit more headroom, if you like, or a bit more certainty that they would hope not to breach that level.
Yeah, absolutely. And I think from my own experience, I mean, the only time that I've really seen companies blowing through covenant levels or indeed approaching them and looking like they're going to move through them has been around times of crisis. So, we're thinking big trending moves like, that one expected, like Brexit, the Brexit move that we saw in sterling, or 2008. In 2008, I saw, with the fall in sterling against the dollar at the time, or the dollar strength that we saw, there were a number of our corporate clients that were forced to renegotiate their RCFs or their banking relationships due to either breaching those covenant levels or knowing that they were going to breach them fairly at the end of the next quarter. So, and that's the worst possible time to come back and renegotiate an RCF or bank lending in the height of a crisis. So, what I would say is that these things are best dealt with a cool head when the market's calm, when your banking group is stable and everything is settled, rather than having to deal with it in the height of a crisis. So it's always worth getting these things right and thinking about them continuously during periods of calm as well as during periods of volatility as well.
Yeah, I could completely agree. I think that's a very good point about the timing of approaching some of these questions and keeping them under constant review.
Yeah. The next slide we're moving on to is, I guess, tactical factors or factors that impact some of these the stress levels that we see in some of those charts that we saw on the previous page. So I don't know whether you just want to comment, but obviously we're made up of two things. Obviously, the underlying spot rate, which can have big trending move, but obviously also the interest differential between the currencies considered. So I don't know whether you had any comments on that, Colin. And obviously, a lot of movement, particularly in interest rates this year, and that can be important for the underlying stress of some of those curves that we saw on the last slide.
Yeah, definitely some huge movements this year, as we're all very aware over in the last 18 months.
Yeah, and some correlation breakdowns as well. You can see in spot as well.
Yeah, correlation sort of works until it stops working, I guess, doesn't it? Yeah, for me, maybe the takeaway of this slide, apart from the point that these are generally the relevant market factors, the interest rates, the differential, the FX spot rates. The takeaway of this slide to me is one of timing, as you said, I think, and looking at whether some of these factors pull in the same or different directions. So maybe I can sort of bring it to life by talking about a UK company that had made a dollar acquisition, and structurally it knew that it wanted to have dollar debt in place in order to offset cash flows, credit rating metrics, some of the net assets, the factors that we talked about previously. So that was sort of pulling them in one direction, but pulling in the other direction was the fact that historically, dollar had been significantly more expensive than either sterling or euros, as the bottom left chart shows. So that's the interest rate differential. So the dark blue is sort of saying, well, what's my dollar interest rate less my sterling interest rate?
Yeah.
And over the last year, well, actually that switched around. So you can see that dark blue shaded area becomes negative, where the sterling, and this is a 5-year interest rate, the sterling rate moved above the dollar rate. So actually it would have been a very opportune time for them to put that dollar debt in place, because the factors are now pulling in the same direction, that they could have taken the opportunity to reduce FX risk, to leverage, to hedge their net assets, and also to reduce their cost of funds and lock in that, it was sort of getting on for sort of 70 basis points of interest rate benefit at the time. So I guess the point is that this is a dynamic question, really, and that these are the market levels to monitor. And you might know strategically what you want to do, but timing also plays an important part.
Yeah, absolutely. And I think some of the larger and more sophisticated clients that we do see are constantly monitoring those, all of those factors, and adjusting accordingly to take advantage of the market, the underlying market moves. So just, I guess the last slide is we're nearing the end, is how do you synthetically create foreign currency debt, and what kind of tools do people use?
Yeah, there's a mixture of instruments, and people probably think about them in different ways. I mean, the obvious one is having actual debt in the currency that you want. That may not be possible due to access to markets. It may not be as cost effective. So how do you synthetically create that debt? Well, the instruments we've shown on this page are FX forwards, or rolling those forwards with FX swaps, or cross-currency swaps. And this is really just a brief summary of some of the considerations, the pros and cons, if you like, of those instruments. So maybe just running through it very quickly. The left-hand column is short-dated FX forwards. So you see this forming part of companies' balance sheet hedges quite frequently. And some companies consider them as part of the debt mix. Some companies consider them separately. But this is really using short-dated forwards, as we said, to hedge those risks and roll those then be using FX swaps. What are you doing when you enter into those trades? Well, you're hedging the spot rate, and you're hedging the forward point, so that interest differential, only generally for a short period. So, for example, until the 3-month maturity of the instrument. The benefits, these instruments will have a smaller credit line utilization, therefore probably smaller charges up front. However, those charges might vary over the life as you roll the trades, and on each roll date you have the cash settlement for the sort of the full notional value of the instrument. Maybe if we compare that at the other end of the page to cross-currency swaps, what are these? Well, people generally think of them as instruments that are used to convert both the principal and interest of debt into another currency. So that can be on a fixed basis, fixed floating, whatever companies want, really. Mm-hmm. So in this case, what has the company done? Well, it's hedged the FX spot risk on both principal and interest payments. and it's locked in the interest rate differential for the term of that trade. So it might be, I don't know, a 5-year cross-currency swap, for example. It's locked in that differential to the extent the swap is a fixed versus fixed interest rate instrument. What puts people off maybe doing these? Well, the credit line usage is larger because it's a longer dated trade. Therefore, there's more sort of risk for the hedge counterparty. The costs as a result tend to be larger. The amount of line that's needed tends to be larger. The flip side of that, I guess, is that the pricing is known upfront for the term of the trade. That again, if it's a fixed swap, all those cash flows have been locked in.
Yeah.
So yeah, but pros and cons to different instruments. And
yeah,
again,
and I think some of the on the client side, what we've seen is that some of our more sophisticated clients, and one client in particular I'm thinking of, which is probably one of the largest manufacturing engineering companies in the UK, with some huge US long-term US dollar currency debt and also some revenue flows, kind of uses all these instruments from time to time. So if the market gets stressed and they're having to pay very high credit charges on some of the longer dated hedges they'd like to put in place, they shorten the duration and they start to use shorter dated FX forwards, which they look to roll out when the market normalizes. Or they might use longer dated FX forwards if there's a credit play for them, or indeed to lock in some of the really long dated stuff, they might use cross-currency interest rate swaps. So I think, there are pros and cons to each, but I think some of the more sophisticated treasuries move through those quite seamlessly and utilize all of these as assets to potentially get an effective synthetic management of foreign currency debt and revenues in place.
Yeah, I agree. Okay, so that pretty much brings us to the end of the presentation, I think. So key takeaways. What would I say as key takeaways? Well, number one, understand the main factors that typically drive companies' debt mixes. So we walked through them at the start of the presentation. As I said, one of the key things in my mind is that it's important to focus on not just one of those factors, but to consider the balance of them in the rounds, because things change, the company structure might change, the earnings mix, the company might grow, and obviously market rates move around, credit positioning changes for better or worse sort of thing. So it is a dynamic topic, which is what I think makes it one of the more interesting risk management topics.
Yeah, and further to my comments earlier, I think you should rely on your banks or use your banks in terms of helping you understand what the risk factors are. So where that larger company I was speaking about earlier thought a lot of their risk was in their EM currency pairs, it wasn't. It was really all about sterling against the dollar. So really understand that and understand what the risk factors are within your book.
Okay, so I think that probably rounds us off for this presentation, Alex.
Great.
I'm not sure what we have in the way of questions on the line.
Yeah, no, I mean, one last observation for me, and the key takeaways, just thinking about it, is just be mindful of your covenants, particularly in where we look like we're coming up to an unprecedented event, like a COVID event or like a Brexit vote or anything like that. Just think carefully around where those are. If there is a big trending market move that could potentially put you at risk, I think that's also something to consider. But yeah, I mean, I think that was fantastic. Very quick whirlwind tour. There's a lot of ground to cover and quite a complicated topic. So really appreciate your time. I'm just going to have a quick look and see if there are any questions. Please feel free to pop any of those in the chat, if you could. And I don't think we have anything, but just from my side, thinking a little bit about some of the questions around EM currencies and EM debt. I mean, I've never seen anybody taking some debt and putting it into some of those EM currencies, even if they've got substantial debt there. So I'm guessing there you're looking at more using financial derivatives like NDFs or option structures in terms of managing that. Is that something that you see and that you have experience of, or do we really get involved in these conversations really around mostly G10?
Yeah, we definitely get involved in these conversations, and I suppose how do we get involved? Well, the team that I look after here in the bank, we help companies by providing quite in-depth quantitative analysis of some of these risk factors. So that might be one way. I guess for a lot of EM currencies, there's a trade-off for companies that the cost of hedging generally tends to be quite expensive. So how do they balance that up against the risk of a sudden FX movement, a sort of jump in the FX rates, and then what sort of tenor, what instruments can they get? So yeah, it definitely comes up in terms of analyzing the risks.
Yeah,
it's probably hedged less often than obviously G10. So I think you made a good point earlier, but one of the multinationals looking at their EM exposure, but actually coming to the conclusion that they could cover a large proportion of the risk by focusing on the core currencies. So that, to me, that tends to be the answer for a lot of companies.
No, I think that's a good point. And I think, just for the group, I think we have a lot of internal resource to be able to facilitate that. So if it is something that's giving you some concern, or you'd like to do a little bit of analysis into, please lean on us. Please talk to your friendly salesperson, or drop a line to Colin or myself, and we'd love to come out and talk to you and help you understand what risks you're facing and how we can help you manage those. So I think that was it from my side. I don't know if there are any last parting comments from you, Colin, but I think otherwise we'll leave it there.
No other comments other than to echo what you said. Very happy to help companies navigate this topic.
Excellent. Well, thank you everyone for joining us today. And as I said, we are building a database of these. They'll be online. I'll share the link. I should have put it in the back of the slides, but if I do circulate the slides around, I'll copy that link in. So please feel free to do that. Actually, somebody's very kindly popped it in the chat, so you can access it there if you want to see some of our previous masterclass recordings. They're all on there. So thank you very much for joining us today.
Thanks, Alex. Thank you.